Hello and welcome to Decoding with Jaslin. In today's episode, we are diving deep into investment strategies with a true expert, Mr. Rajnish Mehan. Rajnish is currently the Executive Director and Chief Investment Strategist at Prudent Asset India, but his experience spans over 2 decades in the financial markets, including firms like Motilal Oswal. From building successful ventures to advising on equity, PMS, and mutual fund portfolios, Rajnish has a wealth of knowledge to share. Welcome to the show, Rajnish.
Thank you. Thank you.
We're very excited to have you, especially with the current scenarios that are going on, right? But before I get into all of that, right? You have over two decades, right? Around 23 years of experience in the financial services space. What sparked your interest?
In finance, see, my uncles used to invest in shares, and whenever we used to, have a family get together, so they used to talk a lot about shares. That this much money I made, and this much dividend I get, and all that. And that's the first where I got to know about shares. That there is something like shares, and I always wanted, to enter the share market to make money. So in my family, like, nobody had done business or they were not into this market. But my uncles, they were just investors. They were also doing their own job. And so, but I always wanted to, come to Mumbai because I was in Punjab in Chandigarh. I wanted to come to Mumbai to, learn about stock markets and, be a part of the financial world. And then I started, reading newspapers, economic times, business magazine, and that's how I started, taking more interest in finance. At those times, like parents were, you should be either doing engineering or medical, and who goes to stock in the stock market? So it was a little very difficult. My mom pressurized me to do engineering, so I said, okay, fine, I'll do engineering. I'll get you a degree, but then I'll go to Mumbai and pursue my career in finance. And she said, okay. That's how I did my engineering 4 years. I came to Mumbai. I did my MBA in finance in Mumbai. And then I started, I got a job placement in Motilal Oswal from the campus itself. So that's how the
Okay.
career started. Yeah.
Nice. So you were very passionate about it from very young age.
Yeah. Very, very passionate about. In fact, even in my engineering, I had started. The parents used to send me pocket money, and I used to save 1,500 rupees and started investing in shares that time.
That's, that's very interesting and so nice to know that, back then itself you started investing. And I also saw that you have also founded an education solutions firm in between, right, Mehan? How did that sort of happen, like the link between finance and education?
See, what happened was that when after working for 5 6 years, I used to take a lot of interviews of students from MBA colleges and all. And then I found out that there is, they lack skill, they lack, what is required actually in the job. So they come out with the bookish knowledge, but they don't have the practical knowledge. And that was one part. And secondly, actually, it happened also accidentally because I started with a, art portal. Like I was also doing investments in art. So I had a lot of paintings, one of my a colleague, he suggested me that if you have so many paintings, why don't you make a website and
Oh.
display it over there? So and I said I have no idea, but okay, let me try. So I made a website on in art, and when we made the website, I saw that it's so easy. You just make an admin portal and you can upload a lot of things and all. And then I thought, yeah, we are not making much money in our paintings were not selling. Then I started learning about SEO, about digital marketing. This was like 2000, 8, 9, those times. And then I found out that this sounds, this is interesting. Internet boom in India, like after 2000, Y2K, internet boom will come in India. And we thought that why not start something in education? Because as I told you, I saw students, not able to, what you say, have the skills basically when they come for job. So that's how we started, career-based portals where we were providing them all the information. We were doing career counseling for them. So all that is the way that we started in that, and did that for 8 10 years. COVID stuck, and after that, the websites, the traffic, and all came down. There was a lot of competition, that happened. So then I thought enough, and I handed over that to my wife because she was also my partner in the entrepreneurship journey. So, and I thought I will go back to finance because that's my passion. Because all these 10 years when I was doing all this, I was always investing into stocks and I was always researching stocks, reading. So that continued. So I thought I just want to go back to finance. So that's, in 2021, I again came back.
Nice. So, let's talk about your investment philosophy, right? From what I understand, you have a very unique approach, right? Can you talk about that? Can you explain what is your approach for somebody who is a layman and who doesn't understand stocks? So, what is your approach, and how do you sort of, why do you think that is effective?
See, everybody has a different investment approach. When I was in Motilal Oswal, so, Mr. Ramdev Agarwal, he had a approach, he used to follow Warren Buffett. So there was only one approach. You buy a good business and you sit, tight for long term. But because I was also working, doing job in equity market, and I had targets where I had to generate brokerage, for the firm. So I had to churn basically the portfolio. So the long term investing thing I could never do in the beginning, So it was always, buying, stock went up 10, 15, 20%, you sell, you switch to another stock. So by doing that for 10, 15 years, I developed my own model, wherein I also understood that fundamentals is very important because if earning growth is not there in the company, fundamentals are not there, management is not good quality, then these stocks, even if they go up, okay, and you get stuck in these stocks because in my career, I've got stuck in so many times where the stocks have, become 110 for, and they've got delisted also. I mean, it's a learning process. Still today also I am learning. So then I developed, by practice, I developed a model wherein, I would select stocks based purely on fundamentals. Okay. And then I will use technical analysis to make the entries and exit in the stock. Okay. And to hedge that, I will use derivatives. So that's why I developed this model, which you call it a TFD model or you call it FTD model, which is a fundamental, technical, and derivatives mix. Okay.
So, can you explain that each of the parameters of it?
Yeah. So fundamental analysis is, I look after the stock like fundamental analysis. There are two ways to go about. One is a tops up and one is a bottoms up, tops down and bottom up. So top make you identify a sector which you think is going to go good. Then you identify stocks in that sector that will do well. And then you see whether, the management quality is good or not, whatever the management has said in the past, whether they have delivered or not. Then I, check the cash flow, whether it is cash flow positive, the debt levels, should be very little. It should be zero point 0.5. I mean, less than one, but mostly I see it should be less than one. Then the return on equity, should be more than 15%. So there are a lot of some other factors which we
So,
see.
for somebody who doesn't understand, like, what is a debt level?
Debt level means debt to equity levels. So
Debt
if
to
I don't
equity should be
debt to
for you,
equity,
you said. And you
yeah,
said what is the number you follow typically? Less
0.5,
than? Less than
0.5.
0.5.
Yeah,
So for every amount of equity they have, they should have less than 50% debt. Okay.
yeah.
And
So
then
that then the return on equity should be more than 15%.
return on equity should be more than 15%. And this you look at like how many years?
I see mostly 3 to 5 years, last 3 to 5 years. Even if it is, let's say, 3 years back, it was 12%, but now if it is improving, 13, 14, 15, every year, if it is improving, that's also okay. So three, four, five different factors are there. So I see that these are like, factors where you, select the stocks based on. And then once I select the stocks, then what I do is, in the past, it was not available because that time only, balance sheets
Would
and
you
all were
be
there.
able to share those five factors?
So I told you three factors means
So
one
debt,
is, yeah, debt
debt,
should be there, ROE should be more than 15%. Then you check the
yeah,
management quality.
okay, understood.
Okay. Yeah,
Management, cash flow, and have they delivered on whatever they have promised? Okay, so the
yeah.
five factors. Okay, got
Yeah.
it.
So then what I do is I now, because the data is available, so I attend a lot of conference calls of the company, okay, where I go past 2 to 3 years and attend all the quarterly conference call of that company. I see whether, whatever management is promising and whether in next quarters, whenever they have promised, whether they have delivered or not. Okay, so that's the way to, check. And that's it. And so this is the fundamental. So once you shortlist based on this, and then I check the technical analysis because that tells you the demand and supply in a stock, whether institutions are buying or not. Then yes, I also check institutional shareholding. How much is the promoter holding? So promoter holding mostly I would like to see is it could be more than 50%. wherever the promoter holding is low, I don't enter that stock because there is a lot of supply in the stock outside. And if the promoter has, low stake, that means he doesn't have confidence, in the company. But depends on sector to sector. Like banking, obviously, the promoter holding will be lower because you need to keep on raising capital. So depends on sector. But then, so that's how I choose the company. And then I choose the technical analysis. I check which levels to enter in the stock. Okay. Once I make up my mind that, okay, this is the level. So first, if the stock is really very good, I will always buy 20% of my quantity.
By how much quantity you said?
For example, if I want to invest 10 lakhs in that stock, okay, I will buy 2 lakhs worth immediately. And then I
Okay.
will wait. And I will wait for the technical analysis indicators. I will see whether this stock is in a correction mode. There are a lot of technical factors like RSI, MACD. So I see that. Based on that, then I make an entry point. And the moment I'm confident, okay, so then I invest my full amount. So once I've invested the 10 lakhs in the stock, okay, then I use derivatives to hedge it. So what I do is that I, buy put because see, every stock will not have derivatives. I mean, futures, every stock is not there. So if it's a small cap where there is no derivatives I just invest in it. But wherever there are futures available, derivatives available. So what I do is I buy put, at a lower level, okay, for protection, and I sell out of the money calls. Okay,
So for
so
those who don't understand, right, can you like explain derivatives on a high level?
that, that's a vast, it will take.
I know. Derivatives is vast, but maybe like just from a layman language, right? If you can like simplify it a little bit
Okay.
for people who are watching.
Derivatives is, basically, it's something that derives its value from the underlying asset. Okay. So underlying asset means, like, for example, I'll give you an example. So for example, there is Nifty, or Sensex. So
Yeah.
Nifty, the underlying asset. Okay. A derivative means, a future means whether that if I want to buy in a future, like I feel that Nifty is going to go up. Okay. So then I buy the future. Okay. But I pay only 10 to 15% of the margin to buy that. Because see, I have a view that it will go up, but somebody else has a view that it will go down. So for every buyer, there is
Hmm.
a seller. So now the seller thinks that it's a sell, so he will sell. I think it's a buy, so I'll buy. But because I am paying only 15% of the margin, I will be paying a little bit premium in the future. So for example, if let's say example of Nifty or let's say Reliance. So if Reliance is trading at 1400, if I want to buy a future, it will be trading at 1410 or 1415. So approximately 1% will be premium that I pay. So that premium goes basically to the seller because seller is selling at a higher thing. It actually derivative actually acts as a loan. So where it's a
Right.
margin, you don't have 100% to invest. Okay, so you just pay 15% of the margin and you can take the position. But that is only for 1 month. Now this is future, and then you also have calls and puts, which are called options. So that is again an option to buy or an option to sell the stock. The underlying asset remains same, Reliance. So if you using options, then there is no underlying price, but there are premiums. So it's purely premiums on options, call premiums, and there are put premiums. So based on that, the rules. I mean, as already it's vast, so we can have another session only on derivatives. And so that's like the FD. So I use this, three factors. So why I do is because this using derivatives, it gives me protection to my portfolio. So whenever there is a big fall, okay, so I'm protected. Like for example, if there is a fall in Nifty in 10% and I'm hedged by using derivatives, my fall will be let's say 7%, 6%. So that's
So
it.
give me an example, right? So imagine stock ABC, you have shortlisted with fundamentals. So you said that if you are planning to invest 10 lakh, you would maybe invest 2 lakh once you have shortlisted with the fundamentals. Then you will do your technical analysis. And then when you feel that the point is right for entry, you will then do the, invest the remaining 8 lakhs. So now you have this 10 lakh worth of stock of ABC. Now, what kind of like, so give me an example of how you then hedge it with the derivatives.
Okay. So what I do is that once I bought this 10 lakh position, okay, for example, let's say I bought the share at 100 rupees. Okay.
Okay.
Now 100 rupees. Now I know the stock will go up, but there could be some like this war situation or something can happen where the stock can fall, you know, below 90, below 80 or whatever, 20%. So I limit myself that okay, I will not go below 10%. Okay. So what I do is I buy puts at 90 strike price. Okay. So I
Okay.
pay a premium. I pay a premium of 2 3 rupees, 2 rupees, let's say, and I buy 90 strike price put. So now, if it goes to 90, I am safe. If it goes till 90, because I pay 2 rupees premium, till 90, I'm okay. I can take that loss. But if it falls below 90, if it goes to, let's say, 70, then I am protected because my 2 rupees premium that I have paid, okay, that will become 20 rupees. Because 90 minus 70, 20 rupees is the premium that my put will get. So whatever I lose on the stock, okay, I will gain in the put. So that's called hedging. So that is a hedging. Now, second thing what I also do is, even this 2 rupees premium that I have paid, okay, so let's say the stock remains between 95, 100, 105 or something. So then I lose 2 rupees because I will gain only if it goes below 90. So then what I do is, now I have set a target. Okay, I'm buying this stock. This stock will go up to, let's say, 120. Okay, so 20% gain. If I'm getting in 1 month, I mean, it's great, right? 20% gain. So what I'll do is I will sell a call at 120 strike price worth 2 rupees. Okay. So this 2 rupees put and 2 rupees call, they get balanced. So if the stock remains between 90 and 120, I don't lose anything because call में 2 रुपए मिला और इधर put में 2 रुपए दिया, so it's balanced. So I'm hedged downward.
Right.
Side is also protected. But yes, if the stock goes above 120, okay, then I start losing. Above 122 actually, because 2 rupees I already have from the put. So if the stock goes up 122 के ऊपर, then I start losing. But there also I don't lose because what I'll do is, because I'm hedged, I will sell my shares.
Right.
So I made 20%.
Right. That's like a very educated approach towards investing, which I think would be very useful for anyone who's listening. I, for example, only do like long term. If something goes down, I just wait. Sorry?
So I have done. So what I have done is this. This is more of a trading where I 80% of the time I spend this, but 20%, yes, the stocks that I feel are long term. Okay, that I also invest and sit for long term. So I have divided my portfolio, like that, because I told you I have a habit of trading. I love trading, so that's why
Right.
70% of my portfolio I do trading, and 20% portfolio I invest for long term and forget about it. That also, long term also for me, long term is also not more than like say 3 years, max to max. Because see, now the world has become so dynamic. Like, Donald Trump is coming and he will say something. You've invested a stock, export oriented stock for long term. Okay, and he comes and put up tariffs on those companies or that sector. Like now what he's done today, he's cut prices in, pharma 10%. So that long term anyways becomes short term. So it depends on
Right.
business is. Like if a business is really good.
So you said your portfolio is like 70 to 80% trading. And typically when you say trading, like what is your, do you mean day trading or do you mean like monthly trading or not day
I,
trading, right?
No day trading, I won't suggest in the beginning of obviously when everybody starts, I had done a lot of day trading, but every time I have done day trading, I have burnt money in lakhs. Sometimes my mother parents had to pay, for the losses. So learned a very hard lesson. No day trading at all. No, it's only positional trading for 1 month, 2 months, 3 months, or 6 months maybe. That's all. So nothing. I mean, see, the trading is that a stock, which whatever I buy, minimum the stock has to go up by 10%. Okay. So why
Right.
12% actually? So why I have said that is also because I hear a lot of interviews of like all these big experts on DB. So they and you have a track record that Nifty has given a return of around 12 to 13%. Okay, 12 to 13% over last 20 years. That's the return. So if I buy any stock and I get 12% on that, okay, in 1 month or 2 months, so then I think my job is done. So I exit the stock, then I find another stock that will give me 10 12%. So that's how, see, everybody tries to beat the market. Everybody who's investing, they try to beat the market. Otherwise, you buy index fund, right? Or you buy Nifty. So, but when people are buying stocks, doing so much research, they want to beat Nifty. They want to beat the index. So there are ways to do it. Now, somebody will sit long term, invest in good 10 stocks, and wait for long term. Some stocks might go down, some will give up, some can become a multi-bagger. Okay. But that is not my focus. So I just, just 20, 30% in those type of stocks, but rest 70% I rotate. So 10 to
Right.
12%, 50%, if I get, I just exit. Now, for example, yesterday, in Friday when the markets were down, there was a stock, Technoplast, just then. Uh, it was 500 at the peak, in October. And fundamentals are very good. It's the largest plastic, containers manufacturer in India. So the stock price fell to 310. and I saw an opportunity, so I purchased at 310. And today the stock was up 12%. So I the stock is up 12%. So I booked half the profit, and now I will ride it. So that
Right.
reduce your cost also. So now let's say I sold half. Now the half that the cost that is way below. So now I will ride it. So now I will wait for 3 4 months, 6 months, 1 year when it goes up to 450, 500 or whatever. That time I
Nice. So, with all of these, right, can you give me like three investment rules that you say that, you have to follow?
the investment rules. Okay. See, first of all, again, learned hard way is diversification. So what I used to do previously, like if I had 5 lakhs to invest and I'm very bullish on one stock, I used to put entire 5 lakhs in that one stock. Because if I think that stock is going to double, so why should I search for another 5 stocks or 10 stocks? So that's what I used to do. But then again, learned hard way. RBI will come and do some action, SEBI will do some action, or the management has done some, but or some policy change that happens or whatever, and you lose big. So first thing that I would say is diversification. That you should always diversify because you should look at the risk. What is your risk taking capability, and based on that you have to diversify. So first is diversification, and then second I would say is you should what you call always do regular investing. You should be regular in your investing because see what some people do is like for example even mutual funds they're doing SIPs. So what they do is now once the markets were coming down, okay, they suddenly stop their SIPs. They think that we will invest once the war is over and all that. But you see today's move. Today the Nifty was up by 3.5%. Okay, and average stock like portfolios were up by 5 to 6%. So just one day if you miss, your alpha creating opportunity is gone. So that's another thing that you have to do is you should always invest, regularly. If you're doing SIPs, you should continue to do with that. You should not stop. Invest for, long term. And third investment rule I would say is, rule I want compounding is another thing that works really very well when you do long term investment. So another rule investment I would say is that you always go for long term investing because what happens is that the power of compounding starts playing out after 5 6 years. Okay, when your money compounds. So that's another thing that you should look at compounding. So these like are the main things.
So, diversification, be consistent, and sort of, the power of compounding, let it play
Yeah,
out, right?
and risk
Okay,
management.
understood, understood. Okay. You mentioned a couple of times, about the markets going up and down with the whole, India Pakistan scenario. So, if people are watching now, what is your advice to them? In a situation like this, in terms of their investment portfolios?
See, we have seen, in last 20 25 years, I have seen, I will not say, but there is so many times there have been war. We saw, Russia, Ukraine, we saw, this Israel war that was going on. Then even in India, that Balakot, that strike had happened. Before that, Kargil war was there. So whenever these, wars are there, I think these are the opportunities for invest for long term. If the fundamentals of the market look good, if the earnings are going to be there, okay, then I think you should look at the long-term picture and not short-term. So one should stay invested. I mean, this entire fall from October, whatever I stayed invested. And if you are, let's say, now depends on the tool that I mean the investment we're using. If you're doing in stocks directly or you're doing mutual funds. So if you're investing in mutual funds, again you stay put. If you're doing SIPs, you should continue to do your SIP. Don't stop your SIPs. Okay, because the India's story still looks good. Earning growth, yes, have come down a little bit, but because of the base effect, because there were elections last year, okay, so that is the reason that government spending was less. So I think government spending will start now this year. Plus, we have a base effect. So I think the earnings will be, in early teens, 12 to 13%, the earnings that we expected. So that much return, if the earning is 12 to 13%, that much return market should, give comfortably this year. Plus, because, India GDP continues to grow at 6.5%, then your corporate earnings is growing 12 to 13%. Your per capita income is increasing. So the spending power in India will increase. So consumption, is the sector that consumption will start increasing. So, and India is more of a domestic, market because we have a huge population, okay, huge consumption market. So domestic oriented companies stock, okay, you should always, look those to buy in these tough times. Okay, because now
So when you say domestic, is it like, your HUL and companies like that?
Yeah, domestic consumption, like Havels, KI, Polycab. Okay, these are domestic consumption stocks, Hindustan
Right.
Aeronautics. Then even domestic banking and finance is domestic. Then coming to infrastructure, because infrastructure, roads, construction, everything is happening. That will continue. Okay, so that is another sector that you can look at. So these are the, I mean, sectors. But overall, if you see the market, to me, and now though in fact, the I think war situation is also stabilized moreover. So I think now the market today we saw it's already gone up, and I feel it will continue to go up.
Right. So, you mentioned in terms of diversification, you mentioned mutual funds and you mentioned SIPs and things like that, right? Typically, if someone is investing in mutual funds, right, you said domestic is one sector, you can sort of invest in infrastructure, banking. What is like an ideal mix, of, so for example, I'll tell you my portfolio, right? So I have digital, I have infrastructure, I have banking, I have gold, all mutual funds. I'm a very safe player. I'm very scared of stocks. I have gold, and so I have these mid cap, large cap, small cap, all of these, right? Is that the right mix, or am I still missing out things that you think I should be like, what does a good mix like look like?
First of all, whenever we meet clients, mutual funds, investments, it's always comes through profiling. Whatever is the client profile, how much risk-taking capacity that the client has. Based on that only we suggest the type of funds or type of exposure that should be taken. So the general trend when if a person is in young 20s, 30s, you can go for small caps and mid caps because there the chances of more returns are there. Now, if the age is more than 50, 55, 60, retirement planning and all that, so then you go for large cap, mid cap oriented funds. So all that investing depends on the fund. Thematic wise, if you see, so a mix of portfolio, if you want to say, so the category wise, there are only, three, four categories: large cap, small cap, and there are hybrid.
Mm-hmm.
Now, because of this uncertainty and geopolitics that is happening, we have been investing, a lot of money in our clients in multi-asset. Like you said, you have these funds and you have gold and this. So multi-asset funds, with actually 60 to 70% they have in equity. Okay, they have 10% in gold. They have 5 to 7, 10% depending on which fund you choose in silver, and then they have in REITs also. So real estate. So you get an exposure of all the four asset classes in a multi-asset. So, but again depends on the client to client profiling is what we first see the profiling and then based on that.
Right. Now, these days, everybody wants to invest, right? Whether it is in stocks or bitcoins and all of that, right? So now I'll give you a scenario. So somebody say who's listening, they are somebody who's young, has around 10,000 rupees in their account and they've received like a first salary of 30,000 and that's going to be their salary now. Where should they start?
Say start SIP. Okay, first of all is people don't have a habit of saving, habit of investing. So the first salary when you get, so people will go out and spend. I'll buy a bike. I will buy a more expensive mobile phone. Okay, so instead of doing that, okay, maybe first month, let's say because you have earned and you want to spend it, that's okay. But from second month onwards, okay, you should start an SIP because see you can start directly equities, but only if you understand. Okay, if you understand equities, it is better to start, or you go to an advisor, or you choose a mutual fund, whichever route you want to choose, but you have to choose equities. Okay, because equities is the asset class which is going to give you 13-40% return. That is one which is going to beat inflation. Okay, and that is the class where your money will compound. Okay, so better to start an SIP. From that, you need to spend less, save more, and that's how you start. And once you start the SIP, you will see that you're investing every month, and after 1 year, you will realize that it has grown. Then, if you're interested in direct equities, then you need to study, research, and you can start that also. But I think SIP is one, and then again, but you need to see whether how much is your saving and how much if they have any loan or not. So all that again will depend on the profile. But whatever
Right.
is the salary you get, you should start investing. That should be the habit that you should go with.
So you wouldn't recommend youngsters to start investing in stocks with their first salary unless they have read up and informed about
Yeah.
it just by seeing trends and all that. You would
No, no,
recommend mutual funds, SIPs.
SIP. SIP is the way to go. See, there is another thought, which I had that is that, like for example, swimming. If you learn swimming, only by jumping in the water. So if you want to actually learn stocks, okay, so I would say you do try it out. Okay, you spend 10, 15,000, 20,000 if you want to waste that money because you will learn only by losing. Okay, because if I will keep on telling, don't invest in crypto, don't invest in, stocks. Okay, so listen, they are not going to listen. So it's better, you burn your hand and then learn the hard way. So it is better if you want to do that, or you want to start with an SIP, a habit of good long-term investing, because that's the way to go. Because over a period of years experience, you've seen that investing in stocks is not easy. Okay, so you need to actually study, research, listen to management, understand the business basically when you're investing. Otherwise, you make a lot of mistakes. So better trust the fund managers and go the SIP way to start with.
So that's so basically, yeah, I mean, that may, I mean, even when I was hearing your analysis, right, you go listen to all their quarterly meetings and that's how you invest. So SIP is the way to go for anybody who is starting out, I think mutual funds and all of that, right? Now, currently, if you look at YouTube or any social media for that matter, Instagram or anything, right, there is so much content around finance, right? Whether it is crypto, whether it is stocks, whether it is NFTs, like so much content, right? Now you are an experienced person in this industry. Do you feel like it's useful, or do you feel like it's just sort of hyping a lie? Because I know youngsters who come and tell me I want to invest in stocks because people are investing in stocks and getting so rich. So what do you feel about this whole finance wave on YouTube?
Content, I mean, there is so much content available. Now it depends on, what you choose to watch. Okay, I spend every day, I make sure I spend 1 hour on YouTube. Okay, today also I spend. So that is, my learning. So I choose what to watch. So the problem is that the younger generation, whatever is thrown at them, they are consuming everything that is going on. And then this finfluencers and influencers are coming up and starting all this, so they are following them. Okay, so these people, they don't have any experience. They have not burnt their money, so they have not invested. Okay, and they give you all these type of gyan on the internet. Okay, to invest. I mean, so obviously, if you follow them, you are going to repent later on. So the best thing is if you want to follow, if you want to, there's content available. There's a very, very good content. There, you need to know which are the good investors, okay, world over or in India, and who have already made money, okay, by investing in stocks, because or in any asset class by investing, who have made money. So if you follow those people, okay, so obviously your chances of losing money is lesser because they have a formula. They have tried it for 20, 25, 30 years. Consistently, they have been making money. So if you follow them, your chances of going wrong are very little. Whereas if you follow these youngsters of 25, 27 years old, who have not experienced actually, they have not even seen cycles. Okay, they have not seen wars. They have not seen even COVID, because most of these influencers have come, after COVID when the market was going, one way up. So the content on YouTube, I will tell you, is very, very good. Okay, I follow it. So, but you should know what to follow, whom to follow. Okay, that is very, very important. Not follow blindly whatever they are saying. Do your own research. Even if you're
So
following a
you,
young, you need to do
yeah.
your own research. If you follow them blindly, then obviously, maybe 6 months, 1 year, you will make money on their advice. Okay, but then ultimately you will lose money because they have not seen cycles.
Right. So if you follow somebody who has seen cycles, who's actually put in their own money and either lost some and gained some and, lived through that journey. So then, they give you that advice rather than going for youngsters who maybe have just seen one cycle, of which might be like a prosperous cycle. We've all seen post COVID, like you said, a lot of good returns come through.
Everybody has made money, but now you see in last 6 months, okay, a lot of
Yeah, even I've lost money. I mean, I have SIPs, so I try to like not bother about it. But I can see the amount I had in December in my kitties, the same I have now. So I'm like, okay, but I'm gonna trust
that's
the
the
long term
short-term thing.
wave.
Yeah, long term. Yeah, yeah, certainly long term you'll make money.
So, all right. Now, in terms of the standard strategy of say earn and save, right? A lot of people are doing that, like I said, including people like me. But I don't know if it is the cost of inflation or whatever, but you still feel like, you're not cracking that, the finance like you still feel you're running behind, right? Sometimes do you feel like, is it just our generation that wants more, or is there something missing in what we are doing?
And so people are, you're right, people are earning and people are saving, but saving doesn't beat inflation. So you need to invest that money. So I would say when you're saying earn, save, and the next step should be invest. Okay, now saving people put their money in an FD or in gold, just one asset class. So obviously you're not going to beat inflation. So that's why investing in the right tool is also very important. Okay, so now in India, average inflation is 5 to 6%. Okay, now if any asset class is giving you 6%, okay, 7%, so you're not going to make any money ultimately. You'll be there. So that's why you need to choose equities where it gives you 13 14% return. Last 10 years, obviously 6 7 years, gold has also given you that much return. Okay,
Yeah.
but over beat inflation, the extra 7% that you earn, that will help you grow your money. Another feel what I feel is that people are not budgeting properly. They're spending more than saving. They're earning, but they're spending more. That is another. Other thing is that people don't, create a emergency fund, you know, in their life. So what happens is that suddenly, if there is an emergency, okay, you have to, because I have experienced that also. You are invested. Now the markets are down because of this war or any other thing, and there is an emergency. You have to sell your positions at a loss, okay, to use that fund. Okay, and then now when because the market is up today or it will go up in next week, and you are never able to enter back in the market. So that this also causes the financial. So it's always you need to have a proper plan wherein you also need to create an emergency fund at young age. Okay, it's still okay. I mean, once you're just starting in and all. But over once you're in late 30s, 40s and all, you should also start creating an emergency fund so that your investment doesn't get affected. The compounding that we were talking about, the compounding should continue. Okay, so if you create a emergency fund, that also helps you a lot, which a lot of people don't do.
Typically, how much would you say should be like an emergency fund compared to, say, somebody's expenses?
Again, it depends on person to person, but approximately around 10% of your saving. Let's say if you're earning 50,000, so 5,000 a month should be there in that. Depends again profile to profile and this, but I would say 5 to 10% should be there in your emergency fund.
Okay, so 5 to 10% at least you should try to keep into an emergency fund, which would like overall, from
Yes.
annually
And
also sort of.
another factor when you're talking about this is the overspending. People take a lot of leverage. Now your income is less, but you want to buy a bike or you want to buy a car. People take housing loans. So if you are earning more and you think that you are saving, you are investing in a house, but 7.5% interest you are paying on your housing loan. So if there is an appreciation in properties, it's okay. Okay, but if you see even the properties last 10, 15, 20 years, it has given you 6% return. Property also doesn't beat inflation. So a lot of people take leverage, to buy a house or to buy consumption, anything you can say, a car or something like that. So they are also better you invest first, you create emergency fund, and from your investment, if you create assets, then it is better.
So what about like, what about like real estate investment? If somebody is taking leverage and doing a real estate investment, properties also of different kinds, right? So you can have like a flat or a house or just plain land, right? All of which you can take leverage and sort of, what about in those situations? Because flat, at least I feel like typically it does not give you a returns. But what about when you have like land associated with it?
See, you're right. The land has given a lot of money, but then again, you should have a knowledge where to invest. Okay,
Hmm.
even that, then land deals. There are a lot of problems. Money gets stuck. Same land is sold to some other people. There is no proper paperwork. So a lot of issues are there also. So again, depends on the profile. If it is a a young guy who started earning and all, I don't think you should go, drag his pay.
Inflation. Got it. Now, if somebody is like creating a financial plan for themselves, right? Okay, this is where I want to get in say 5 years, 10 years, right? What are the key things they should be looking at to make a good financial plan for themselves?
See, financial plan, first thing that you have to see is, what is your financial goal? Because every financial plan, comes with a goal. So what are your goals? First, you need to set up that. And based on that, you need to see what is your earning, then what is your expenses, okay? And then whatever money is, left after that, that you should be investing, okay? Then you also need to see, because there's a risk management, you also need to buy an insurance, okay? Because if anything bad happens, okay, so you should be insured, so that insurance part should always be there, okay. And then I think next is you need to keep on reviewing your portfolio and your financial goals, because people set a financial goal for 1 year, 2 year, 3 years, and then it changes with the income or it changes with your needs. So you should always monitor that. So main thing is that you need to make a budget, that okay, this is my earning, that is first step. Then after that, what is my expenses? After the expenses, okay, you buy insurance, and then whatever is remaining, we should invest that. So that is how we go with the financial plan. And again, obviously, as I told you, it all depends on the again profile of the client. So everything is out to that main thing, that profiling should be there.
Right. Now, if we look at like the overall market, right? You mentioned Donald Trump coming in, a lot of tariffs being put in, right? There is talk about a recession coming and things like that as well. What is your view? Do you think recession is going to come and hit the markets?
I don't see a recession. Because see, Donald Trump is doing all this because he feels that to avoid the recession only, he's doing all this thing. He wants basically dollar to depreciate, so that the exports from US can rise. So that is why he's doing all this. Even, I mean, 1 or 2 quarters, in US you can say the recession will come. But India, I don't see any recession coming in. Probably US, yes, Europe is 0.5%, 1% growing at all. But I don't see recession coming, overall impact. In India, so we don't see at all. India is growing at 6%, so there is nothing doing. A little bit slowdown you can expect in US. See, now China, he has increased the trade barriers. Now today, again, the new deal for 90 days where he's reduced it from 145% to I think 20%, and even China has reduced it to 10%. So all that, but that we knew that he's just negotiating. So that's I think now done. And today also, if you see all the markets, Dow Jones is up by 1,000 points. So that's all part of that. So I don't see recession coming.
Understood. Now, recently there was a trade agreement signed between UK and India, right? What is your view on that? Does that trade agreement have any impact on the layman and also in terms of, their investments and financial planning?
No, I don't think it will impact much on layman. But thing is, we see some things will become cheap because of the duties. Whatever is we are importing from UK, so those things will become cheap. But companies-wise, it will benefit a lot of Indian companies, who are exporting to UK. So the market is opened up. Now, because of the reduced tariffs of free trade, so we will be able to export more because we will be competitive compared to Vietnam or China or Philippines, Bangladesh. So a lot of sectors that will benefit. For example, textiles. Okay, so our textiles to UK will increase, even food, agriculture products and all. So, pharma. So a lot of sectors that will benefit, with this. And the layman, I don't think will impact much. But in investment, when you say yes, if you invest in certain such stocks which are going to benefit, which sectors that are going to benefit with this. Okay, obviously investors will make money in that. And prices wise, some things that we are importing, the prices of I think chocolates and Scotch whiskey, here, single malt Scotch drinker, then obviously the cost will be reduced. So person who is drinking too much will save, and that money can go to SIPs.
Right. Okay, got it. And right, so
Beginning.
we
Yeah. This is just the beginning. This is a UK trade deal that's signed. We are also negotiating a deal with EU. We are also in talks with New Zealand and also US. So once we have deals with everybody, then automatically our exports manufacturing will increase a lot, which is good for the overall economy.
right. So those are some, what are the key trends you see that you know will shape other than these deals that you mentioned?
Trends as in?
Like in finance, right now, what are the trends that you are seeing that you believe will shape the upcoming future uh, in finance right now?
Finance, I feel, see, digitization is already done. Mostly that is done. So now AI and, fintech has come in. So I think AI will really drive, finance in the future. Even in advisory, if you see in our line, robo advisors are coming up, and the research also, equity research that you're doing. There is quant investing that is already started. There are a lot of funds that have started in quant, where the system, you put in all the data in the system, and the system will give you, what stocks to buy and what stocks to sell. Investing active, I think artificial intelligence, the more and more the system learns through machine learning, I think that will, really create a lot of difference. And obviously, with more AI and more digitization that will come in, the number of transactions will increase because the transactions will be faster. Okay, so number of transactions will increase, and we will see lot and lot of people coming into the market and investing because still in there about 10% of the people are investing in mutual funds, stock markets, and all. So once the digitization happens, the automatic artificial intelligence is using robot advisory will come in, quant investing, and the younger generation, are more reading and learning all about this. So they will be more attracted towards, the market because doing a fundamental research turns up, as I told you, listening to conference calls, it's a tedious job. It's not so easy, doing research on stocks. I think this AI will make it easier for the, new generation.
Are there any tools already that you use from AI or machine learning? You mentioned that there are tools.
I am still old school. Okay, so I am not using, but yes, there. I mean, we use. I mean, there are screeners that have come in. There's a screener.in, site app which is there. So now that everyone is using, so where you can screen. As I told you, I have five factors, fundamentals, in fact. So you go to this app, you just put in, I want a list of stocks which have a ROE more than 15%, which has a debt equity ratio of less than zero point 0.5. Okay, so these, and then a lot of factors. ROC should be more than 15%. So all these factors you put in that, and the system just shows, the list of stocks that you should be considering. Then you can put in, I want a PE ratio of less than, 15. Whatever factors you put in, it will give you the list of stocks. Screener is one, that I am using. Others, there are other tools available, but I use only Screener.
Right. Now, if we look at like the traditional route, right, the way our my parents save and probably still save a lot, like FDs, recurring deposits, chit funds, right? All of these, are they outdated, or would you still recommend that okay, maybe a little bit in these is not bad?
Again, profiling. Okay, uh, so obviously FD, as I told you, you should create an emergency fund, for example. So your emergency fund, which I told you, that can lie in FD. Okay, but for a person who is above 50, 60, and he might need, money. Let's say if he's not getting any pension money, so then obviously he needs to put some funds, and there are people who don't have even in medical insurance. The way, FD helps a lot. But as far as returns are concerned, beating the inflation is concerned, obviously FDs are no. So people are taking out money from FDs and started investing. So as they're getting educated through your influencers and YouTube channels and all that, watching TV. This generation. So I mean, this generation is not into FDs at all. They are doing only two things: investing or spending. But
Right. So if
but
yeah, go
if you
ahead.
see, our parents, when they used to say that you should save, you should put in FD, you should put in real estate, all those safer assets, and they have made money. But now this generation, okay, they don't have the responsibility to buy a house because parents have already built it for them. So that's why they are just investing, spending, and increasing India's consumption. That's why I said you
So
can
have,
I can think of.
sorry, that's why you said you should start an SIP. Okay. Have you actually seen like a difference in the profiles between someone who's older and someone who's like younger in terms of their attitude towards
Oh yeah, yeah.
investing?
Totally, totally. I mean, I have, a lot of friends and, their daughters, sons, or whatever they have started earning. And, whenever we have a discussion and all, and I tell them, that you should do SIP, you should start investing in this. Yeah, okay, I do through 2000 SIP, but what about stocks? Okay, what about crypto? What about so they want action basically. So they're saying okay, we are ready to take risks. Okay, because I think this generation have they're starting with good salaries. So I think they want to take more risks. They want to enjoy it maybe. That's how they're doing it. But there is a lot of difference in decline profile in the old age and the new age, how they invest, how they think, how they spend. A lot of difference is there.
And what do you think about crypto since you mentioned it? It's something that's sparked a lot of debate, right? Like there are
Uh,
people who are into it, who have made a lot of money. Like I said,
they,
I only
they have
invest
a
safe, so
they
I'm very skeptical. But
in real
right.
estate, crypto, what is there in it? Tomorrow, you have a crypto, let's say, Bitcoin has become famous now, but let's say there are so many new cryptos coming up. Suddenly, overnight, it gets shut. Okay, the cryptos, what do you have in your hand? Nothing. So it's all virtual money, basically. So virtually, one is buying, one is selling, another is buying, taking the prices up. It's speculation. I mean, I would not suggest at all. But there is so much
Right.
money to try to go there.
And same, I'm assuming. What about like NFTs and things like that?
Same, it's all same.
All same. You feel it's better to have like a actual asset to
Actually.
sort of invest in. It's been very, very informative, the session with you. Before sort of closing out, if you had to give one takeaway for everybody or one money habit, which may be like, if you had to like tattoo on everybody one money habit or one takeaway, what would that be for every person who's listening?
One takeaway, I would say again, invest regularly and diversify. So I would just like it, invest and diversify. So that's the one thing I would say should be doing.
That's, been very informative. Everyone who's listening, if you are struggling with money, just two things you remember: invest and diversify consistently, and you would do well. So it
As
was
long
a
as making,
great,
as long as
yeah.
doing investing in India, I think you will make money because we are just at the beginning. What China was 20 years back, what Japan or US was 40 years back, we are at that stage. So if you are investing in India, you are definitely going to make money. Just invest regularly, sit tight, and you will make money.
Really, really good to listen to you, Rajneesh. So I personally found it very informative. I've also lost some money in day trading. I started with this whole monthly thing, but you get greedy, right? You're like, oh crap, you can take margin in day trading, right? Which you can't have it on. I've done day trading. I've lost some money in that, and then I was like, okay, it's better just to be safe. And I think what you advised is very apt on point. That even if you want to experiment, keep some money aside. That okay, this is the amount I'm going to experiment with. Either I lose or I gain, it's fine. It
No, you are
shouldn't
going to
like
lose.
impact.
There is no
Yeah,
gain.
that's what happens.
You have to lose. I'm telling you, you will gain 1 month, 2 months, 3 months. In that next fourth month, thing will go, and it will be minus.
You're so right. You get
I
greedy.
mean,
It's
you
like,
are just
you
speculating,
gain
right?
some, then you get greedy, and then you lose. Yeah.
Yeah, you get greedy, and more than greedy. Actually, trading. I'll tell you. We never discussed about that. Trading, 90% behavior. It's a human behavior. Okay, you are
Right.
right. The probability. Okay, this will go up. This will go down. There is no underlying. What is the underlying asset? What is the business doing? You don't understand. So the day traders. Okay, they just see the screen or they see some technical analysis and all, and they just buy. Okay, so ultimately you are going to lose money because one day you will get overconfidence. Okay, because it's a human behavior. Okay, human psychology. So you will get overconfident that okay, I'm making money. I cannot lose. I have learned it all, and then the next day you will lose it all.
Yeah, I was when I used to do day trading, right? I used to read up a lot about this, and I think that was one of the things I heard. Day trading is actually understanding human psychology, right? And behavioral. And what do you think the bulk of people will do about that stock? That is all day trading is, right?
What will bulk
Like
do?
you
You have to
said,
do opposite.
the
I said what
sorry?
the bulk will do. If you want to make money in trading, whatever the bulk will do, you have to do opposite. That's how you will make money.
Oh, is it? Okay. I thought it's better to like follow the pattern. Right. No,
Round and
I
robin.
like that is one thing. Yeah, I've always noticed in day trading, I used to make money only, by short. And buying, I used to never make money. It was always short. That was always more, even when the war happened in my head, I was thinking maybe I should short some stocks, but then I was feeling guilty that I shouldn't make money out of a bad situation. So I didn't do it. But yeah, I think day trading, like you said, everybody burns their hands when they want to experiment, and you learn some lessons, you win some money, and you lose probably that whole amount a little bit more.
So even if you want to learn and do trading, I would say never leverage. Okay, if you
Hmm.
have 50,000 and you have kept that much amount for trading, just take position of 50,000. Because what people do in trading is they have 50,000 and they will take a position of 5 lakh. And if it is down,
I mean,
1
that's the
lakh, you
point
lose.
of day trading, I think.
That's what people try to do.
I
Na? They have only 50,000 and they want to make 5 lakhs from that. And that's how I'm saying human psychology. They end up losing.
Correct, correct. And I think a lot of people end up not putting stop loss amounts and things like that, right? They just end up trading, just open-ended trading, which is
That
obviously very, very risky.
trading has different rules now. So that stop loss is one rule.
Right. So I think I've also learned in my life, like trading is probably not great. I was always an SIP person, but I think Nikhil Kamath, right? He does a lot of trading. So with that inspiration, I thought, okay, I'm gonna study trading, and I tried trading that way, but didn't work out. I realized unless I'm doing this as a full-time job, if you have something else alongside, there's no way you can do anything. So I just stopped it in 1 or 2 weeks after reading a million books around it and just still losing money. I was like, okay, SIPs are just better off. You put auto debit on SIPs, your money just gets cut, and hopefully with India, like you said, just being still on the premise of growth, and with everybody around us having that sort of focus on the progress wheel, we are all optimistic about the overall India picture in terms of investments.
Yesterday, I mean Saturday, I was having a chat with Mr. Vijay Mantri, and he showed me a chart of HDFC Flexi Cap. 30 years, 30 years, the return is from 27% CAGR. 40 years is 19%. So, I mean, what else you want? I mean, you see the compounding, in 30 years, how much the money will grow if it compounds at 27%, or in 40 years if it compounds at 19%.
That's true. I think, yeah, the power of compounding truly plays if you do like a good SIP, or a mix of good SIPs. You will start seeing it. All right. Been a very informative session. I learned a lot, and I'm hoping everybody who's listening to this would also learn a lot. Thank you so much for your time, and to everybody who's listening, thank you so much. We would be linking Mr. Rajnish's, LinkedIn and socials on the description if you want to connect with him. He does provide individual client specific investments advice and things like that. So if anybody wants to connect with him, feel free to. Thank you for tuning in, and thank you so much, Mr. Rajneesh, for your time.
Thank you. Thank you very much for giving the opportunity. Thank you.
Don't